So this is an episode with Jack Melnick, who is head of DeFi at the one and only Berachain. We love having Jack on. He's a returning guest at the Blockmates podcast. His insights and takes on the industry are second to none. And primarily this episode was just talking about this new Boyco and RFB, which is this incentivization program that Berachain are rolling out, which is one of a kind. I think it's extremely forward thinking, and I'm really excited to kind of see it play out. If you want to know how to probably position yourself to take advantage of this and get involved, and stick around for the full episode because Jack goes into detail how you can kind of take advantage of that. Give us a like, subscribe, share it around with people that you think might benefit from this episode. And as always, enjoy the show. What I've been kind of looking at recently, and I think with the explosion of what's happening with kind of half-assed L2s and like some kind of put together in a garage L1 kind of setup, and it's just like, who are you looking to attract here? Because like from your perspective, what are people looking for? They want liquidity, they want users,
Yeah.
and they want to be a profitable business at the end of the day. And I think that aspect of it as well is sometimes completely overlooked.
Yeah, agreed. So like this is something I've actually thought about a lot lately, is like, what is the role of the chain? What is the role of the app? And this even ties into like a lot of this discussion lately in my eyes of everyone wants like consumer dApps, right? And why do they want that? Because they're like, I want to bring new users on chain, right? Like this is the new version of like Sandeep being like, we're bringing on the next billion, right? and and there is some truth to that, right? But if you kind of think about the way a lot of other industries work as well, there isn't necessarily always this onus of every single company being like B2C in the way that it feels like a lot of people expect consumer dApps to be. Um, and so, in my eyes, in many ways, right, like a successful chain will do two things. A successful chain will make it easy for high quality developers, right? Like it should be as meritocratic as possible, if I had to distill it. But a successful chain should be able to take high quality developers with good ideas that want to work hard on them and put them in as good of a position to be successful as possible, right? Whether that's acquiring users, whether that's solving cold start problem, whether that's integrations and introductions to other apps that help make their stack more efficient, right? And so that becomes like a B2B element. And then dApps from there either have like two choices effectively. It's either go directly to consumer, which is like this new way of consumer dApps. Or alternatively, I think like one of the things that will become increasingly popular and that we're taking some kind of opinionated bets on is effectively having like distribution tools that are responsible for addressing the end consumer directly, right? And I think in some capacity, you see that with things like Moonshot. You're seeing that with the rise of Telegram apps, like all of these things that are like, look, like I'm not really going to do almost anything aside from like white label some general solutions that already exist on chain today. But what I'm going to do is like make it really easy and palatable for the UX of those apps to be actually like hitting end consumers. And so I think like within that mindset, right? You then end up as the chain of like, okay, how do I actually help these applications get online, right? And part of that's like cultural, and part of that is actually like technical and product wise, right? Like you actually need to give them the right products and right positions to be successful. And we looked at a lot of the things that people had done in the past on like solving a new chain start. And I think there was like an opinion that we could like try and do something better, right? Or at least novel.
Yeah. So like where, because like from investor and trader and speculator's perspective, it feels like what we've previously had has been somewhat of a misalignment between what the chain wants and what the end user wants, and that kind of plays itself out in different ways. So you've had, not to go through like the brief history of DeFi and how you kind of get a chain up and running, but you've had age-old liquidity mining for applications to get on there. That was extremely inefficient. People were paying way too many tokens into the hands of people that were extremely unaligned with what they wanted to do for the short, medium, and long term. Then you had like incentive programs by let's go and pay people in the chain's native token to see who protocol can get the largest amount of TVL. That just spawns out this like ridiculous kind of vampire attack game of who can give the most protocol native tokens to kind of drum TVL. So then the protocols can then get the native token from the chain. And then we've seen like different iterations, and we've moved on to like kind of points, which is liquidity mining, but a bit obfuscated and a bit more opaque, and the team get to decide how much of their token they get to give away at the end, if at all. Where's the happy middle ground, and how are you guys approaching it? Because one thing that's extremely interesting about Berachain, which is must be an absolute headache, but a blessing at the same time, is there are so many builders there. There's like a lot. There's a lot happening.
Yeah, and that's even a middle ground of its own, by the way.
Yeah, yeah.
And so like, I'll even add a few other things that I think are big problems that are probably less top of mind for you, but I think like as someone that's actually like, okay, what am I doing on the product side, product strategy side a lot of the time, like something I spend a lot of time thinking about is like the first thing is like, let's even think about some of the extensions of like the points or new chain bootstrapping programs that we've seen get really successful. So like probably starting with Blast and then going from there into like the Mantas and almost everyone that's launched a chain in like the last 6 months, right? How does it work usually? It's first of all like historically been an incredibly opaque process, right? Let's start with the low-hanging fruit, right? Like really opaque. I'm sending money to a multi-sig. I don't know who my counterparty is. I don't know the duration of time that my assets will be locked in the multi-sig. They were like, it'll be like 4-ish months. You don't know what you're getting in return. There might be some points counter, but like you said, the value of points is, or like the redemption ratio of points is decided ex post. And so there isn't really any transparency there. And like just to be clear, like Boyco won't fully do away with points, but it's trying to put the impetus on applications to be really clear and targeted on, are you using points, are you using a proxy for tokens down the line, how are those assets redeemed, and giving users a lot more transparency in their ability to make assumptions about the value of those things. And ideally enforcing as much of this as possible with smart contracts, like really minimizing the counterparty risk that you're forced to take, or at the very least making it clear what the counterparty risk you're taking is, right? Like you can actually go in and look at the smart contract that you will effectively be opting into from a risk perspective. And if you want to ape into the one that says, send it to Jack's multisig, you can. But ideally, you should know that that's where it's going up front. And like if you want to do something else, you can. The second big issue, right, is that if you think about how a lot of these things worked, right, like what is the actual goal of putting liquidity on a chain? There's like kind of two goals in effect, right? The one that is like the real goal, which is like I want to get liquidity into applications so my chain actually works. And then there's like the secret goal, right? That chains don't really talk about, but like is always there. And that's like I want to have as much TVL in my bridge as possible, so that way I can like be really happy with myself and how much TVL I have. And like when we're doing this stuff, like we really only think about app TVL. Like chain TVL is something we'll look at just to make sure it's healthy and like growing the way we want to, and like has the ability to support the apps. But a lot of chains treat like that bridge TVL as an end in itself, even though it's like necessarily not productive liquidity until it's deployed in an application. And even taking it one step further than that, right? Like if you think about the way that this process works, like if you're offering someone 10% to bridge ETH into your bridge and not to do anything else with it, but the rate on every other chain for like idle ETH is 10%, what you've actually done is, like you said, yes, you've vampire attacked liquidity into your ecosystem, but you've also kind of fucked over yourself and your builders now, because you've raised the hurdle rate for ETH on your chain to 10% now instead of 3. And so now if I'm a builder that wants to come in and acquire that ETH, or if I'm a chain that wants to subsidize a builder's acquisition of that ETH, it means I have to now give Blast gold on top of Blast points to get the liquidity from the bridge that I've already brought in into the application, right? And so there's like both a double spend issue here, like I'm both acquiring it into the bridge and then into an app. And there's also a capital efficiency issue here of like, I actually could have acquired this liquidity for less money had I chosen to have apps go and acquire it directly from another ecosystem rather than acquire it from me, right? Like you actually become a middleman for liquidity in this example. And then the balance here as well is that like with an eco like Bera, as much as we love the Berachain builders, like there will be applications that get hacked. Like there will be applications that have bad actors working at them, right? And ideally, we're able to kind of like help patrol for this as much as possible, and like us being around for a while hopefully makes that a little bit more controlled. But like, it's unfortunately like an unavoidable side effect for the ecosystem. And so one of the things we're also trying to be thoughtful around is like, okay, yes, like we have a lot of builders, that's amazing. What can we kind of do as well from like a minimum product perspective to try and mitigate the risk of like bad actors being the first thing that someone experiences on the chain, right? And obviously that's not perfect, but for Royco, we're going to require like at least one audit with a preference for two. We're doing our best to make sure like all of the underlying code base is as secure as possible, and so trying to like dot our I's and cross our T's there as well. But yeah, it's definitely a large problem.
Yeah, can you round up in like TLDR what Royco Boyco is?
I
People can
can, yeah.
ignore because it's a recent kind of announcement that you guys have put out, and it's kind of like really at the center of what we've just kind of previously talked about for the last 10 minutes, isn't it? So
Yeah, you're absolutely correct. I probably should have led with that. But Royco, so I'll start with Royco because we love Jay and James. So Royco is a platform that allows applications to build liquidity markets. And what a liquidity market basically is it's an order book style market effectively under the hood. But an application can effectively say, look, here is the amount of incentives I have. I want to acquire liquidity in this asset or this double-sided asset, this pair, and get like pretty complicated in terms of like how they're actually structuring that deal. And then a user can effectively come in and say, look, yeah, I'll give you, I'll cross the spread. I'll meet your ask, and I'll give you $10,000 of liquidity at that rate. Or alternatively, they can come in and say, well, look, like you only asked for $50,000, but I actually have $100,000 of lick, but I want it at this rate, right? And they can negotiate directly with the application for that liquidity via the Royco market. And so that in and of itself, I think, is like a pretty interesting design in that, like, speaking of capital efficiency, right? Like you're actually better able to target someone's willingness to pay for liquidity, or someone's willingness to offer liquidity in exchange for payment. And it, as like, this evolution of liquidity mining that you were talking about earlier, I think it's like a pretty natural next step. And I think it's something that is quite thoughtful in its design as a baseline. Where it gets really interesting though, right, was for me when I was on the call with Jay and he was pitching this to me, my first thought was like, wow, you can probably do something really cool around this for a chain pre-launch, right? And the basic idea for Royco is with, so we have like layer 0 and Stargate under the hood that facilitates the bridging infrastructure. And so basically from any chain that's connected to Stargate, we can accept deposits in USDC, USDT, DAI, WBTC, WETH, or any OFT. And we can even integrate other third-party bridge standards as well, like Native or whoever else. Hyperlane, I think a couple are using. And what that basically means is now, before you had this thing where it was like, okay, I have, deposit contracts in ETH mainnet or maybe Arbor OP if I want to vampire attack those folks. And then you did this classic like two-step bridge process. For Royco, what will in effect happen is users will be able to deposit any major, and applications will be able to take in liquidity in any major or omni-chain token from any chain. Users will be able to see the applications that they're depositing into. They'll be able to see the smart contracts that they're depositing into. They'll be able to see the incentive tokens that they receive, the duration of their lock, and they will also be able to negotiate with the applications directly via the Boyco interface. Which helps solve a lot of those problems that we talked about around like transparency, around being able to like process your rate of return, around applications acquiring liquidity directly. Because what actually happens on mainnet launches, an application will deploy their contracts on mainnet. They will effectively like verify that those contracts are the same contracts that they put into the Boyco platform. Once that is done, the Ethereum market, which is where like all the core logic is hosted for this, basically gets greenlit. And then all of the chains that have deposits for that application market get bridged to Berachain and automatically deposited into the application smart contract. And the cool thing underlying there is there's these thing called Wayroll wallets. And the Wayroll wallets are actually owned by the user that did the deposit. So you always retain custody of your own capital, but it enforces a lock on that deposit. And so basically what that means is that while you can't pull that liquidity until the duration of the lock expires, you do always have technical ownership of that wallet. And once the lock expires, you're then able to withdraw liquidity. And so this also does like has a cool couple downstream implications. And so one is like, you know, the security and ownership properties. Two is like, if you think about it from relative to that earlier point I made around capital efficiency, what's happening here is you're actually really well able to say, okay, for majors, I am able to basically attract liquidity from wherever the hurdle rate is cheapest because I'm offering like a really consistent rate across chains. And then we're also able to do really cool stuff where, like, if I have an asset issuer that's, say, issuing BTC LSTs that are an OFT, right? They can effectively have like Babylon points and LST issuer points or tokens and Kodiak for the money market or Kodiak for the DEX and Gummy or Dolomite for the money market, right? And you get like these stacking layers of yield. Whereas, you know, in another system, you frequently see like all of these apps like PvPing against each other for the bridge liquidity. And this, they're actually like working together collaboratively to attract liquidity from somewhere else, right? And so it creates this the same mindset that we always want to be like that's actually something we spend a lot of time thinking about. Is like, okay, we want Berachain builders to be super, super collaborative. If you're building product that forces them to be not collaborative, you are like failing that, right? And so that was actually like a big thing as well. It's like, how can we make this collaborative?
So a few points on that. So you're like, let's say it was, I don't know, the easiest example is lending and borrowing protocol. So they're going to give you they're going to distribute you like X amount of tokens for Y amount of deposit over Z amount of time. And I assume that fluctuates, but and then you're obviously exposed to the native yield that the assets are being used for, like say if the rapid BTC. So you're getting that if there's like a points program going on with a specific asset that you deposit as well. So there's like this kind of
Correct.
three-dimensional
Yeah.
yield on top of it.
So
One thing,
like if someone's doing like BTC LST loops in a money market, let's say, and it's supply
yeah,
BTC LST, borrow WBTC, loop it, um, and you are supplying WBTC in the money market via Boyco, you would get the borrow side of the WBTC. So like whatever that reference rate ends up being, plus whatever the app incentive token is. And then the other downstream thing that could end up happening there, right, is like if someone ends up putting a rewards vault on that borrow side via POL prior to like your lock expiring and the app auto stakes for you, you could theoretically even be eligible for like BGT emissions on top of that as
one thing I think that's understated here is, well, it's not, but it is at the same time, which I don't think anyone's really cracked, is one, the terminology of TVL is a lot of shit. But then it's not if you use this model. And I know protocols would be able to open up the design space of what they can actually build if they knew they had guaranteed lock liquidity for X amount of time. First one that springs to mind is fixed rate. If you want to go down that route, guaranteeing like they're going to have X amount of TVL in the protocol over a specific amount of time. How is the market going to value time? I know the Tapioca boys have kind of attacking this with like time weighted AML, and that's like a really unique take on it. And theirs is you get a larger discount on the purchase token of TAP, like an option, if you lock a kind of higher value of token for a longer duration. So there's like this the two parts of the formula, like the amount and the time. And that's like obviously the meat of the formula builds that up. But I don't know if there's any kind of anything anecdotally or how you'd imagine that out.
Yeah, it's a super interesting question. And I think your point is like a really, really good one, by the way, in that like if I'm that was actually another thing that I wrote about in this blog when I was putting together all this Boyco stuff that I forgot to mention earlier. But like the advantage that you have as a builder, it's just like I'm so tired from working on all this stuff. But like if you're a builder, right, and you have like 3 to 6 months, let's say, of concrete visibility into knowing, okay, I have at least X TVL on my platform, right? That then gives you a ton of flexibility to be able to go to other products and say to them, look, like I have this guaranteed TVL in ETH, or I have this guaranteed TVL in USDC, right? This is for a money market, right? Like this is, I can now go to an asset issuer and say like, this is guaranteed leverageability of your asset if you want that, right? And it really gives you this flexibility to go and instead of focus on like surviving the first night, right? Like you're in fucking National Geographic, you're instead able to go out there and be like, okay, I have some confidence. I have 3 to 6 months of runway to do this. Like I have to acquire real users. I have to acquire actual integrations. I have to get some product market fit. But it makes it so that you actually have like that confidence to be able to like go out and do that, which I think is really, really important, like you said. And then I think like one of the cool things on the design is any of those other, like I do agree, like there is clearly time value, right? But different builders are going to have different ways of valuing the amount of duration that they need for their application to solve that cold start problem. And different users will have different willingnesses to pay for more duration. And also it will be on a per asset basis as well, right? Like if you think the assets that you're supplying might have like a shorter half-life than something like BTC or ETH or whatever, right? You're probably actually going to want to like take less duration, or like causing you to take duration would become more expensive. And so I think that's what one of the elegant things about Royco is, like, while I think the TWAML is actually like a pretty elegant solution for a specific application that knows how to price the duration that they want and gives users the flexibility to do the same. Royco is, I think, like a really elegant solution on the other side, in that like it's almost, it almost feels like a Uniswap factory, right? It's like, look, like here are the variables. You tell me what you want, right? And then I can create that for you.
Yeah, no, that's exactly it. It's multifaceted. Like it's more granular, customizable for each specific use case across different assets. And like protocols might have different use cases within the protocols. Maybe it's a, I don't know. Everyone's slowly building towards this kind of full horizontal stack. Everyone's a lending borrowing protocol. There are decks at the same time, and then there are perp decks. Like, so that's happening. So there's different kind of demands for different assets. But what's this going to look like from like a user's perspective? So I'm going to come to, I don't know, Royco. It's probably going to be a Boyco kind of front end or Berachain up. Is that just going to look like a very obvious marketplace for where I want to kind of deposit my assets? Like, how do you kind of envisage? I don't know if you've seen any kind of like UI layouts or Figmas or anything like
Sure have, yeah. And we'll have I meant to have an FAQ out last week to help answer some of these things. It'll be out sometime this week. We were just finalizing a couple small product decisions to make the flow even a little bit easier on the user side that I'm really excited about. Like my girlfriend was laughing at me because I like one evening I was just sitting and like I was on the phone with Jay till like 11 p.m. 11:30, and I get off the phone. I'm like, that's it. We got it. Like, that's the design. And she was like, all right, you're such a fucking weirdo. But the TLDR is basically like, we wanted it to feel like a user, whether they're, you know, an individual retail user or a DeFi native or like a large fund or capital allocator, right? Like they should all have an experience that like feels pretty comfortable. And the goal is, you know, when you're going on to Boyco, I wanted it to feel like this experience of like walking into a supermarket and having like a huge shopping option, right? And having a lot of flexibility in terms of how you're filtering those criteria, right? And so, you know, if we end up with, you know, 25 to 50 dApps in Boyco, there'll be like a small amount of gatekeeping there based off of the audits, and we're requiring teams to have been live on testnet and also buy the assets they need, right? And so all of these things kind of help like filter the list of teams down, and we want to make it like palatable, right? We don't want it to get so spread out across so many apps that no one achieves any exit velocity. Like that isn't serving anyone either. But we want it to be so that, you know, you log on, you see this giant shopping menu of apps, right? And you can say, you know, I want exposure to the perps markets, or I want exposure to the money markets, or I want exposure to the dexes. And you can go in and filter by those types of applications. Or you can say, look, like I have ETH, WBTC, and USDC in my wallet. I want to supply these 3 assets. Show me the highest rate of return expected for each of those 3 assets, right? And then you can filter that one more level and say, okay, but I only want apps that have 3 months or lower duration because I don't want to be locked for that long. And so you have the ability to really kind of like progressively and selectively add all of these criteria to help find the right application in the right position with the right like liquidity deposit for your specific risk profile. You can filter by having single-sided deposits. If you only want some minor risk, you can filter by double-sided deposits like LP if you're willing for some to take some IL. And then you can also find like the specific kind of stacks that are most interesting for you. And then in terms of like the user experience, the way that it works in practice is that like once your order is filled, you'll have the ability to rage quit out of the market until Berachain launches and the application deploys their smart contracts and validates them on Berachain, right? Once the funds are then automatically bridged over, at that point you are stuck until the duration of your lock. That also basically means though, if you have like a situation where an application fails to like launch in a reasonable time frame and the funds stay on your deposit chain, you can always just like rage quit out, right? And so there isn't this risk of like, oh, if the chain or this app gets delayed for X period, like are my funds just locked? Like, no, awesome, right? Like you can always access them. The other thing we wanted to build out is one of the things that kind of I never really liked is like you see people doing all these like, I'm sure you were an enjoyer of like the hyper liquid points games, right? Like what are these numbers worth?
800 I had.
Yeah, look, if they're 100, I'm a happy camper. But like the implication of that too, right, is that when you are offering someone points, you should be able to also allow them to customize the stated assumptions that are provided, right? And so, if someone's offering points on the platform, you'll be able to say, okay, what in like the little slider, it shows like APR, expected APR or whatever, right? You click on that and you'll be able to say, I actually anticipate that instead of 7% of supply going to points, it's only 5%. And I think instead of it being 50 million FTV, it'll be 40 million FTV. What does that do to my APR, right? And so it'll really allow you to also have that flexibility to go, okay, even if the stated assumptions are wrong, is this still worth my time? Is it still worth my money?
So who's building the automated liquidity manager on top of this?
So funny you should mention that. Me being a absolute crazy person, have already been exploring the universe of like Royco Plus products, right? And so it's hard to do like an ALM on top of this because you can't actually touch the liquidity, right? It's locked in that Wayroll wallet that's on like a per user basis. And so you can't like necessarily have like a vault manager exactly the way you're talking about. What you can do though is kind of two things, right? And we already have people to do both of these, so we're like playing around with these. But like one, you can have a money market, right? And so Dahlia is actually specifically focused on building on top of like Royco type markets, right? And so what that means is they can effectively take like your Royco receipt token that you get upon submission into a market, and they can actually allow you to use that as collateral in a money market, right? And so now, even though my capital is locked, I still have access to my capital because they can actually like withdraw the underlying from my Wayroll wallet in the event of like a liquidation, right? And so they actually have really good confidence in like the borrower repayment function. The second, I think, like super sick thing that you can do is I'm super excited for this one. Is like you can actually take this market that you've created, and you can actually theoretically, despite like different payoffs for end users, right? Like you can actually make a Pendle market for it. And the PT represents the liquidity that you have locked for the duration of time, and the YT represents the payoff. And the cool thing is that the YT can represent like if you're stacking, assets and apps and Bera and all these other incentive tokens on top of each other, right? Like you can actually have like a tremendous amount of vol within that YT token, right? And now if you're like a depositor and you're like, look, like I think this is super fairly priced, sell your YT, right? You're actually fully hedged now. But if you're a speculator that doesn't have a lot of capital, but you actually just want to gamble on incentive tokens, well, you can actually now buy YTs potentially from the open market for these top markets to be able to say like, okay, I want the upside, but I didn't necessarily have the capital, right? Very similar to how we saw in the past. And I think it's a super cool kind of like use case for the yield splitting modules. And it's something I suspect like it won't just be Pendle. It'll be kind of like Pendle for the initial push, but I wouldn't be surprised to see other yield splitting platforms added as well.
So what's like the downstream kind of second order effects? How does this play out from the application's perspective? Is it gonna? I suppose it's just gonna create this free open market, and if you're really desperate for liquidity in TVL of specific assets, then you're gonna have to pay up. But then I suppose that kind of is a lot more efficient than just either blanket ban blanketing just like there's fucking 10% of our supply just gone distributed to Justin Sun, who's been farming us for the past 6 months,
Yeah, exactly. It doesn't change anything, right?
pissing everyone off because they've been farming it for months, getting points, and then you're getting $30 in your wallet or some shit. So it's like,
Yeah, exactly. So it's the goal here is there are some, I think, like 0 to 1s in terms of the amount of benefit that applications get relative to traditional chain mining, right? And so that's like, if you think about it as like a chain pre-mine versus Boyco, right? I think that is very 0 to 1. If you compare it to the fact that applications have needed to raise liquidity generally in the past, I think the big innovation is just the sheer amount of transparency you get, right? In that, like, right now, the majority of these discussions happen behind closed doors. Large LPs are getting preferential rates that like end users don't know about. If you deposit on October 23rd and it turns out the season ended on October 22nd, but they didn't communicate that until October 30th, and you were actually getting a reduced rate, and then I bought the YT of that rate and I didn't know it had a different rate than the other one, right? Like it just like can get really weird. Versus in this scenario, someone can still get a preferential rate. Like a large LP can come in and say, I'm going to give you $5 million of liquidity at this rate, and the app can accept it. The big difference is now a user or another LP knows that that was the case, right? And I think just even that added level of transparency is really good, because now you, as a potential liquidity provider in that same application, know that you have some negotiating leverage, and like you can actually push it and like have an understanding of like where the value of your capital is. Or importantly, if you're another application that's been negotiating with LPs and like you can't get someone to bite, and then this other thing happens, you can look at that and go, oh, it's probably because I was actually offering like 20% lower than the market rate for what they wanted in this specific instance, right? And so I think just like that added level of information helps people make effective deal terms.
yeah, there's an interesting dynamic as well with a kind of not a flippening. I think we're probably another cycle off, but the amount of liquid funds coming into the market as well, which will probably see this as a really nice opportunity. Um, the only other side is, let's say I don't know, you put 100K up for London Borrowing Protocol. It was like a six month commit in DAI, for example.
Mm-hmm.
Is that APR is like how granular is the reward payout for the user? Is it like streamed per block? Is it like, can you specify if it's by a specific vesting? Like,
So there are like a few different designs for how this can work, but for Boyco, all of them will have the same design, based on my convos with Jay. And there's like a slight amount of nuance here, right? Like in that the incentive token it's effectively like a cliff at the expiry of the lock, right? It's effectively the same exact thing as like a season in like an airdrop thing, right? Very, very, very similar design. Where it, I guess, gets a little bit interesting though is that if you're depositing DAI into a money market and the supply rate for DAI is 7% and there's a rewards vault on it, let's say via proof of liquidity, and that proof of liquidity gauge offers it an incremental 3%, you can be getting your 10% APR streamed to your position for the supply side in the money market, and then you also have this kind of like cliff payoff at the expiry of the lock, right? And so part of that is also intentional, because if you think about it from a streaming perspective, the onus, like, I would have loved to add a lot more programmatic flexibility in your vesting schedules. The hard part with that design is that you are then putting the onus on all of these applications where you said, like, I'm giving you time to focus on your product and like all these other things, and then you turn around to them and you go like, by the way, you have to have your token live the second you deploy on the
yeah,
chain.
exactly.
Right?
What
It's a tough ask.
what's I'm assuming everything's handled via intents under the hood. Is like, what's that? Who's providing that network? Is like, what's that look
Yeah,
like?
that's probably a little bit of a better question for Jay, but I can answer at least like the high level architecture. I think they're using some like ZK coprocessor stuff to allow teams to basically make their markets like extremely customizable, and like the logic under the hood extremely customizable, but still have it all on chain. In terms of like the basic flow, The way that I think it'll work at the end of the day is you'll have like the Ethereum market, which handles the core logic. You'll have the deposit contracts on all of these other chains for whatever wherever users want to deposit from into a specific application. And then what happens is you'll effectively have like a mirror set of contracts on Berachain, and then there's like the wallet custody logic on Berachain as well. An application deploys their contract on Bera. They validate that it matches the same as the contract that they said would be the case when they created the market. There's effectively like a script that will be handled through an intent-based platform. I think we're going to work with Enso on this. But basically, like that will effectively do the validation and create the script, which then passes a message to ETH mainnet, basically saying like, hey, this matches, greenlight the market. The market gets greenlit. That effectively is communicated to all of the deployments on all of the chains, and basically saying, hey, greenlight. From there, there's a solver that will effectively take the assets, send them to the Stargate contract or the layer 0 interface for the OFTs, gets bridged over to Berachain with a composable call. What that basically means is you bridge the assets and there's a smart contract call attached to it. And or you'll have like a solver on the other side that will actually just handle the logic of the deposit into the smart contract via the Wayroll wallet for like the user custody.
So was this kind of imperative? Because I know, and how were you guys gonna do it? Because there's been so many applications that we've spoke to, we've funded a couple. Everyone wants to be there day one. Like Berachain day one is this kind of like build a meme that kind of goes around. We're gonna be there day one. Everyone says it. Everyone pitches you. We're gonna be there day one. It's fine being there day one, but if you don't have any liquidity to be able to use the application, you're kind of stuck. So like, when did you kind of stumble upon this, and like how quickly have you kind of made this kind of imperative to get implemented?
Yeah, it was one of those things where like this is my favorite part of working at Berachain is like you just have a lot of flexibility to try cool stuff and a lot of autonomy to like execute on it, right? And so basically like this is going to sound insane, but it's true. Like I would guess 70% of my really good ideas come from me being on a phone call with someone and them talking and me being like, I start daydreaming and I'm like, well, what if I could do this and this? And then like, I hit them up 3 hours later. I send them like a 3.5 minute voice memo and I'm like, what if we did this? And that was like probably, I think, pretty similar to what happened here, right? Like Jay was talking through like pitching me using this for the intent that he had created it. And I went to him instead and I was like, hey, what if we did this completely different thing instead? And I am such a mega J fan because he immediately was like, yeah, that sounds awesome. Like, let's do it. And so basically, like, the initial step was Jay creating a really, really cool, very, very flexible product, and me seeing that it served a need that we had potentially. And then, you know, I went to Smokey and Home and Papa about it and chatted with them and Yogi, and the overwhelming sentiment was like, yeah, this sounds awesome. Like, you should go do it. And that was kind of it, right? Like, I just came back to them, whatever, 8 weeks later with like a largely finished product spec. And I was like, hey, you know, does this make sense? And they're like, yeah, I think so. And that was kind of
Sick.
it.
Love stories like that. So what is what's kind of next? Like, I know we don't like doing dates and stuff like that, but um,
No
is there
dates,
a
but
big
we can
is there
yeah.
is there a big push towards the end of the year? Like,
Yeah. There's for sure a big push into the end of the year. You know, we won't say dates, but I think we feel really good about where we're at right now from a product perspective. We're in audits for a bunch of different stuff right now. I think like a lot of the product and mechanism design is feeling like really, really buttoned up, even to relative to when I joined 6 months ago. And so I think we're getting super close. Smokey would kill me if I said anything specific, but we're getting there. And I think it will be a little bit sooner than people expect, but always a little bit later than they hope.
Yeah, of course. Yeah, dates are the kiss of death in this industry. It's like
Yeah.
it's absolutely crazy.
Dates require you to like really force your engineers. Like until you have a finished product, you can't give a date because there's
No,
always something else to engineer. Yeah.
yeah, but engineers are like notoriously,
I will not throw
you
my
know.
engineers under the bus, but yeah. They're
um,
not great at dates.
side tangent. What are you thinking? Because I love like the you and Smokey and Matt. I love bouncing kind of what's going on in the DeFi space. What are you thinking about this kind of push and pivot for app chains and like what's going on in that dynamic there? I'm sure you'll have a nice spicy take for the audience.
I'm so happy you said that. I am like so bullish app chains and so bearish app chains pivoting to become general purpose block space chains. Right. And so like if we had actually gotten true Unichain, like true Uniswap app chain, I would have been so excited about that. Unironically, right? I think that's so smart. Um, Now we're like seeing this universe of chains that are either becoming like general purpose L1s or L2s, either as like regulatory arbitrage, which is like I kind of what I think what like Hyperliquid is doing, um, or just for the sake of doing it because they think they have some like product differentiation. I'm like pretty bearish on that, to be honest, in that I think the majority of them really, really fail to correctly predict just how difficult it is to build out a differentiated and meaningful network of applications on your chain. Like the amount of overhead is insane. And especially if you don't kind of have like new token, new sentiment hype to acquire users, I think it's going to be really, really, really hard. And even if you do, I think like people really underappreciate the connections with the right builders and how much consistent work over a long period of time it takes to convince them that this is like, hey, you've been working on this thing for months or maybe even years. Like you should come gamble it all on my new chain that has like
Mm.
product market fit, right? And then if you take it to even like more of a structural level, I think like one thing I feel very strongly about is like if you look at traditional finance, right? Um, you know, Citadel is an execution based business. Jane Street is an execution based business, right? Like they're focused on like flow, and actually like really driving value through like order flow effectively, right? That's the equivalent of like a sequencer based business in crypto in L2 land, right? It's like I'm going to be able to have enough differentiated product and enough differentiated flow that I can actually charge for that flow at above market rates. But the reality is that like if you are building a general purpose chain and the application space on that chain is identical to almost every other chain, that will not be true at scale, right? Like maybe it is true today, maybe it's true in 2 years. I don't think it'll be true in 5 years. For app chains, you can continue to charge sequencer based flow, right? Because you have a differentiated product and business. But I think like in the same way that BlackRock and Charles Schwab and other retail brokerages and asset managers aren't monetizing based off of execution or off of flow, most general purpose block space chains I think will be forced to monetize off of other things like native yield, right? Which effectively turns you into an AUM based business. And I think like this mindset that a lot of L2s launching have today, and like a lot of VCs have been okay with, of like, oh, having a gas token and a sequencer fee token is sufficient for me to like generate good ROI on my insane valuation that I'm aping into this L2 at, is wrong, like strictly wrong. And so you either need to come up with like other credible business models, or you need to come up with like other generic models for structuring L2s, right? And so this is like one of the things I was excited about on Bera, is you actually get like really good value alignment for the L1 while also delivering some value to the L2, right? Like super high level on like how that could work is, you know, if I think there's actually a lot of benefit to not having your random shitter as the gas token of the chain, because it really increases the overhead from a UX perspective of like acquiring that token and then spending it when you don't really want to be holding it. And so like what if you use ETH or USDC or Bera as your gas token on your L2 instead, right? Like now your UX and acquisition there is a lot easier. And then you use native yield on the L1, and that can generate some yield for you based off of traction in the L2, right? Like the more successful you are, the more of those assets you'll have, the more yield you generate, the more revenue you have. And you can either take that as like true revenue for the chain itself, or you can also build like ancillary designs around that where, let's say you actually do have a token for your core protocol and it's a part of the product stack, and it might even have some pass-throughs, but it isn't necessarily like important to the operation of the chain itself. Well, set up an LP on Berachain L1, right, of your Bera Blockmates token. Put a rewards vault on it, and then use your native yield or a portion of your native yield to incentivize validators to put BGT onto that rewards vault. And now, as your L2 scales, the amount of incentives that you have going to that rewards vault is growing. And so the amount of liquidity in that rewards vault is growing. And if you want it, fuck it. Like if you don't think restaking is a meme, then like go to Symbiotic and take that LP token and restake that LP token in Symbiotic. And now you're also even if you zero out your native token because that's like recursive to the chain itself from a security perspective, you do end up with something that like is actually providing productive security, economic security, if you think that's valuable. You have something that is generating liquidity that makes it easier for users to like speculate and acquire your token. You can build a ton of DeFi integrations on the L1. You're generating revenue based off of your AUM based business. It becomes like really interesting, I think. But yeah, that was like a 5-minute answer to a really simple question, which is like AppChain's good, general purpose block space, EVM block space bad.
Yeah, there's so many like parts of this to unpack that people keep flip flopping on. So, but yeah, I've like even over the past 2-3 weeks, the amount of AppChain first L2s that I've seen come where they like, yeah, we're gonna try and proof of concept with I don't know, CDP based L2, and then if an ecosystem flourishes around that, then we'll go down that route. Which I like the idea of. I think there's some really interesting designs there. But then the question is, if you build an ecosystem off the back of a specific app chain and then build the ecosystem out after, as opposed to what's kind of came first, where general purpose, what happens to one of the successful apps on the app chain? Is that just going to go and do its own L2? Like, and when does this cycle of app general purpose like finish? I don't think it does.
Yeah, I don't think it does either. Like, I think the reality is that like building an L2 as an app chain or an L3 or whatever you want to go, I think like the further up the stack you go, the bigger the trade-offs get today, right? Because you're either like really necessarily opting into some specific kind of like cross-chain messaging stack to actually get composability. But especially on like any optimistic stack, I think it becomes pretty deeply problematic because you're like stacking 7-day windows, right? And the more you stack those, the harder it gets for even like, you're like, oh, just add intents to your chain, right? But it's like, okay, but now your market maker is taking longer and longer and longer duration risk on the back end to fully settle out. And so that is actually like user borne cost at the end of the day, unless you can add on and off ramps directly to your chain, which is its own separate massive overhead, right? I think like Andre was tweeting, it's like $12 to $15 million a year to spin up an L2, and like that's right. Like if you're gonna do the full infra stack of like, I want native USDC and I want high quality Oracle providers and I want Alchemy and like Infura and like all these infra providers, right? Like people don't realize how quick that shit adds up.
Yeah.
Um, and so I think there will be this like, we're in like L2 hype land where everyone's like, oh, it's so easy to launch a roll up, and they're right, but they don't really fully process how much it costs to run a good roll up. And that will like cause some of
I'm
this
gonna
to
go and
scale
launch one
back.
now on fucking
Yeah, Caldera.
Conduit.
Yeah, Conduit, whichever one.
Like $3,000 a month. Like, yeah.
Yeah, exactly. And then
Can't
you
do
realize
anything.
it's like, yeah, exactly. You can't do anything on the chain, but you can
You
launch
can't
one.
even check it because a fucking block explorer is expensive as well.
Exactly, right? Like, yeah, it's like, okay, you want, and from a UX perspective, all those things become like brand risk things too, right? It's like, okay, do I want to go with a tier 2 or tier 3 block explorer to save 350k to 7 figs a year, right? Like that's how much it costs for a tier 1 block explorer. It's like 7 figs a year. It's like if you want Chainlink, right? Like you're going to be paying, they'll execute me if I say something, but like, you're going to be paying a lot of money for that.
Sergey needs some more plaid shirts.
Yeah, exactly. And so, at the end of the day, like, I think these things will reach a natural equilibrium and kind of pull back. Um, the reality is that, like, simply though, the L2 design, if you think about it relative to just like deploying on normal block space, just gives you slightly more flexibility on ways to monetize. I think a lot of people think about that and mentally in their head they go like, oh, this is going to help me find product market fit because like I have more ways to generate value and so my token's worth more and so I can acquire more users, right? That is not true, right? Like if your app is bad, going on an L2 is not going to solve your problem. It can give you a second. It's like very similar to points in that perspective, though, right? Like points were really effective for a lot of dApps because it basically gives you like two shots on goal. In that, like, if you fuck up your points campaign, you just like you said earlier, it's entirely ex post. So you just like you zero out all the points, folks, and you're like, all right, it's all about the token now. And so you get like a second shot, right? And similarly, like an L2 gives you like a little bit more juice of like, oh, I failed to get potentially some initial PMF. Like I'm going to go do this as an app chain. There are some cases where I think that is actually justified, but I think there's just as many where it's like, taking a shot in the dark.
Yeah, and what do you think about? Sorry, not to go too much on tangent, but like the whole idea of like app specific sequencing and gas monetization, like the apps that are creating like huge demand for block space on specific networks, getting their fair cut from said gas.
Yeah, I think there's a couple parts of this in that, like, the first is full transparency. Like, I've been so heads down that I've watched the ass debates, but I haven't actually dove into them to have like a really educated opinion on them. Yeah. And so, no, I just like to be transparent as someone that's like deeply opinionated. If I don't have enough knowledge to like have a really deeply held opinion, I'll say that. I think the idea is pretty cool though, right? It's like one of those things that we've seen people kind of like doing design elements of in the past. Like I think Phantom is rolling out something similar on Sonic. I believe like Frax was actually discussing or rolled out something similar for Fraxtal, where like based off of the amount of gas that's being consumed effectively, like applications are getting rewarded for that. I think there's some really cool merit to that. And I'm not opposed to it. I think it makes a lot more sense for L2s and up where their effective overhead costs for operation are significantly lower. I think it starts to get like a little bit weird on L1 where like depending on how you're actually trying to generate value for the L1, if the L1 just continues to like offload all of its ways of actually like creating sustainable value for the validators on the network outside of proof of stake inflation out of the mix, I don't know how you ever get to a point where like the chain can actually be really like, I know we're like not as concerned about chain profitability because it's a little bit of a meme, but like, I don't know. I do think there is something to be said for like having a chain that isn't just inflating into oblivion to like create value.
Mm-hmm. Well, Jack, it's always a pleasure. Is there anything else I might have missed that you want to bring up? Or
no, RFB ends tomorrow. Boyco soon. Berachain may be real. Thanks for having me.
There we go. All right. Thanks a lot, everyone. There's a ridiculous stat of people who tune into this every single time that don't subscribe. So please go and do that.
Yeah. Go subscribe to Grant. Exactly. He's out here grinding for your bags, and you can't even give him a subscribe. It's messed up.
There you go. There you go. Right. Thanks a lot. Speak to you next week. Bye.
Quick one, nothing here is financial advice. It's for entertainment and educational purposes only. Always do your own research or speak to a financial advisor before making any investment decisions.